Let's say one of your family members suddenly falls ill and requires urgent medical treatment. You may not have enough savings to cover the medical expenses, and you need to pay for the treatment immediately to ensure the well-being of your loved one. This video will provide an in-depth understanding of how payday loans work, their potential risks, and the impact they can have on your financial well-being. By arming yourself with this information, you'll be better equipped to make sound financial choices and protect yourself from the pitfalls of payday loans. But first, do you want to gain access to a wealth of advantages when it comes to your finances? Stealth Wealth Society has designed an interactive course that provides guidance on setting and achieving financial goals, creating a sustainable budget, and understanding the complexities of the modern financial landscape. By making smart investment choices, you can grow your wealth over time and secure your financial future. This course offers incredible value for the lifelong benefits it provides, making it a wise investment in your financial well-being. Don't miss out on the opportunity to secure a solid financial foundation and unlock a brighter future. The link is in the description below. Let's dive in. A payday loan refers to a form of borrowing for a short duration, in which a lender provides credit with high interest rates depending on your income. The borrowed amount usually represents a fraction of your upcoming salary. Payday loans impose elevated interest charges for immediate short-term credit, and they're alternatively known as cash advance loans or check advance loans. Payday loans impose exorbitant interest rates on borrowers and do not necessitate any collateral, rendering them an unsecured form of personal loan. These loans are often classified as predatory lending due to their excessively high interest rates, disregard for a borrower's repayment capacity, and concealed clauses that levy additional fees on borrowers. Consequently, they can ensnare consumers in a cycle of debt. If you're contemplating a payday loan, it's advisable to explore safer alternatives in the form of personal loans. Are you aware that payday loans are not accessible in every state of the US of A? Can you guess the 16 states that have prohibited payday loans? If you're up for the challenge, Stealthies, there's still time to make your guesses, so stick around with us. Payday loans at work. When obtaining a payday loan, it's typically required by the providers to present evidence of your income, usually in the form of pay stubs from your employer. Subsequently, they will lend you a portion of the money equivalent to your upcoming payment. Repayment of the loan must be made within a brief period, typically 30 days or less. Payday lenders assume a considerable amount of risk since they do not assess your ability to repay the loan. As a consequence, payday loans often carry exceptionally high interest rates, and additional fees may be imposed if you fail to make timely repayments. This can pose a significant hazard for borrowers, as it may result in the need to borrow more money to cover the initial loan's costs. How to get a payday loan. Payday loan providers are commonly local credit merchants with brick-and-mortar stores where you can apply for and obtain credit instantly. Alternatively, there are online lenders that offer payday loan services as well. When applying for a payday loan, it's typically required to furnish your pay stubs from your employer to demonstrate your present income status. The loan amount provided by payday lenders is often calculated based on a portion of your projected short-term earnings. In many cases, a borrower's wages serve as collateral for the loan. Lenders generally do not conduct thorough credit checks or evaluate your repayment capacity. Beware the interest rates. Payday lenders impose exorbitant interest charges, reaching as high as 780% in annual percentage rate (APR), with an average loan carrying a staggering 400% APR. While most states have usury laws capping interest rates between 5% and 30%, payday lenders often exploit exemptions that allow them to charge exorbitant rates. For instance, in California, payday lenders can levy a 460% APR for a $100 loan over a 14-day period. It's crucial to consider the accompanying finance charges as well, with an average fee of $15 per $100 borrowed. Despite requirements under the Federal Truth in Lending Act for payday lenders to disclose their finance charges, many borrowers overlook these costs. Typically, these loans have a duration of 30 days or less and provide temporary relief for immediate financial obligations. However, loans often get rolled over, incurring additional finance charges, leading a significant number, up to 80% of borrowers, to become trapped in a cycle of repeat borrowing. In response to the 2008 financial crisis, lending laws have been enacted, and court cases have been filed against payday lenders, aiming to establish a more transparent and equitable lending market for consumers. If you're contemplating a payday loan, utilizing a personal loan calculator becomes essential to determine the manageable interest rate you can afford. Are these legal? In 2016, during the Obama administration, efforts were made to regulate payday lenders in order to protect consumers from falling into what former Director Richard Cordray of the Consumer Financial Protection Bureau, CFPB, termed as debt traps. These regulations were officially implemented in 2017 under Cordray's leadership. The rules introduced a crucial provision mandating lenders to assess a borrower's ability to repay the loan while still being able to cover their everyday living expenses before granting them the loan. Additionally, lenders were required to provide written notice before attempting to collect funds from a borrower's bank account. Furthermore, if 2 attempts to debit an account failed, lenders were prohibited from making further attempts without obtaining the borrower's permission. These rules, initially proposed in 2016, were strengthened under the Biden administration, and the new CFPB leadership established stricter regulations for payday lending, which became mandatory on June 13, 2022. However, in February 2019, under the Trump administration and the direction of Director Kathleen L. Kraninger, the CFPB proposed rules to eliminate the mandatory underwriting provision and postpone the implementation of the 2017 regulations. Subsequently, in June 2019, the CFPB issued a final rule delaying the compliance date from August 2019. Then, on July 7, 2020, a final rule was issued, revoking the mandatory underwriting provision while retaining the restriction on repeated collection attempts by payday lenders from a borrower's bank account. Speaking of prohibitions, payday loans are not accessible in every state, as they're subject to varying regulations across the United States. In fact, a total of 16 states, along with the District of Columbia, have outright banned payday loans in any form. These states include Arizona, Arkansas, Colorado, Connecticut, Georgia, Maryland, Massachusetts, Montana, New Hampshire, New Jersey, New York, North Carolina, Pennsylvania, South Dakota, Vermont, and West Virginia. The prohibition of payday loans in these jurisdictions reflects a concerted effort to protect consumers from the potential risks and pitfalls associated with this type of high-interest short-term borrowing. By outlawing payday loans, these states aim to prevent individuals from falling into cycles of debt and financial instability often associated with such lending practices. Security and variability of payment. This type of loan typically requires borrowers to repay the entire amount in a single payment upon receiving their paycheck. Consequently, the interest rate for these loans remains constant. In fact, numerous payday lenders don't even present their fees as an interest rate. Instead, they impose a set flat fee ranging from $10 to $30 for every $100 borrowed. The majority of payday loans are not secured, which implies that you're not required to provide the lender with any collateral or borrow against a valuable item, as you would in a pawn shop. Instead, the lender typically requests your authorization to electronically withdraw funds from your bank account, credit union, or prepaid card. Alternatively, the lender may ask you to write a check for the repayment amount, which they will cash on the due date of the loan. It's important to note that according to federal law, lenders are prohibited from making a payday loan conditional upon obtaining permission from the borrower for recurring electronic fund transfers, commonly known as pre-authorized transfers. Payday loan timeframes. Credit bureaus, the entities responsible for calculating credit scores, typically retain records of traditional loans for a period of 6 to 10 years. These records can potentially impact your future borrowing capabilities. In contrast, payday lenders generally do not report to credit bureaus, even in cases of late repayments. However, once the lender sells the debts and they're transferred to collection agencies, the payday loan may be included in your file. If you successfully repay your payday loan within the designated time frame, it should not have a negative impact on your credit score. Conversely, if you default on the loan and your debt is handed over to a collection agency, you can expect to see a decline in your credit score. In reality, the occurrence of payday loan debt being forgiven is extremely uncommon. This is primarily due to the substantial profits payday lenders generate from the interest they impose on these loans. Consequently, it's advisable to make every effort to repay payday loans as promptly as possible. Failing to repay a payday loan may result in the account being transferred to a collection agency, which will actively pursue the outstanding balance and accumulated interest. This not only creates an unpleasant situation, but also contributes to an increase in your overall debt, while also negatively impacting your credit. Bank account requirements. While having a bank account is not universally mandatory for borrowing money, lenders who do not require one typically impose high interest rates. This includes many payday lenders. While payday lenders may request a bank account, sometimes having a prepaid card account may suffice to meet their requirements. Due to their exorbitant costs and potential repayment difficulties, it's generally advisable to steer clear of payday loans. In the event that you're unable to promptly repay the loans, these can accumulate, leading to a debt cycle that is challenging to escape. Therefore, it's crucial to only consider taking out a payday loan if you're absolutely certain that you can repay it. Borrowers should exercise caution when dealing with payday loans, as they can be categorized as predatory lending. These loans often impose exorbitant interest rates and neglect to assess the borrower's ability to repay. Consequently, they can easily lead individuals to a cycle of debt. Yes, we know that debts could lead you to live in a hand-to-mouth cycle. We got you covered. Check out this video about 10 ways to stop living paycheck to paycheck and get out of that cycle. And don't forget to subscribe. See you there.